Good morning, afternoon, or evening, depending on your location, and welcome to the Hoover Institution workshop on using text as data in policy analysis. My name is Stephen Davis. I organized the workshop with Justin Grimmer. Today, we will hear about the global impact of Brexit uncertainty from four insightful and very productive researchers. They are Tarek Hassan, Boston University, Laurence van Lent at Tilburg University, Stephan Hollander at the Frankfurt School of Finance and Management, and Ahmed Tahoun at the London Business School. They use text-based methods to investigate the effects of Brexit on publicly listed firms around the world. Their study is one of the most detailed and extensive examinations to date of how Brexit, the referendum, and subsequent developments affected firm-level outcomes inside and outside of the UK. And we're very excited to hear what they have to share with us. Here's the format. Tarek will present the paper over the course of about 30 minutes. Then we will turn to a discussion and Q&A. If you have a question or comment, put it into the Q&A box, which Justin and I will moderate. Depending on the flow of questions, we may combine questions, paraphrase, or ask you to state your remarks directly. We'll probably run for about 60 to 65 minutes in this recorded session. After that, we'll turn off the recording and continue with a more informal discussion for anyone who wants to stick around. Okay, Tarek, it's all yours. Please take it away.
So thanks very much for the invitation. This is about the global impact of Brexit uncertainty. The UK's decision to leave the EU exemplifies how political and economic shocks originating in one country can propagate to affect firms in other countries. And what we're trying to do in this paper is to understand and quantify this propagation. That has often proven difficult because it's hard to measure in general how a given firm might be exposed to a specific policy measure, reform, or other shock, particularly if it's originating in another country. So what we do in this paper is we propose a general text-based method for isolating the firm-level exposure to costs, benefits, and risks relating to specific events. We're going to be using Brexit here as the example of interest. But I think you'll see very quickly that this method can generalize to be applied to a range of different types of shocks. Okay, so let's dive right in. So here are the main findings of the paper up front. The first main finding is that prior to the actual execution of Brexit, there was widespread concern about Brexit-related risks among international firms, in particular firms that are not headquartered in the United Kingdom. For example, Irish firms were worried on average even more than UK firms about the risks associated with the execution of the Brexit vote. Interestingly, we also find impacts as far afield as the United States. So you can see very clearly the effects of Brexit risk specifically on US firms, places even further afield like South Africa and Singapore. The second main finding is that UK and non-UK firms overwhelmingly expected negative impacts from regulatory divergence, reduced labor mobility, and trade access. What's kind of striking is that we've made a real effort to find, evidence in favor of the upsides of Brexit that were touted by the Vote Leave campaign, and we really just couldn't find them. So there's very little evidence of even UK-based firms being happy about Brexit in general. The third main finding is that Brexit risk is strongly associated with significant reductions in investment and employment growth among exposed international firms. So you can see the effects of risks that are generated by Brexit on international firms very clearly in their decisions. And what we found is that sort of the first moment exposure, so think of like Brexit as generating both risk and also being bad news for a bunch of firms. So when you see the effects before the execution of Brexit, you see very clearly the effects of the risk, whereas the actual bad news for firms is priced in asset prices, but otherwise has no effects up until the actual execution of Brexit, which is exactly what you would expect. So let me start by kind of explaining how we measure a firm's exposure to Brexit. So our data set here is text. So we have the complete set of about 150,000 English language earnings conference calls held by more than 7,000 firms that are headquartered in 71 countries. And we're going to go from 2011 all the way through the end of 2019. So we're not going to look at the actual execution of Brexit, because in particular, what we're interested in is how uncertainty generated by Brexit affects firm decisions. The way that these earnings calls work is that the management gives a presentation, and then there's a Q&A session with the firm's analysts and interested investors. Lasts about 45 minutes. These calls are held about once a quarter. So, I'm going to be talking for 30 minutes here. Those presentations are 45 minutes. So they have them once a quarter, so you can expect them to be very important conversations. They're not going to just waste their time. They're going to be talking about important issues relating to the firm. What we're interested in is what share of the conversation between management and investors centers on costs, benefits, and risks associated with Brexit. So how are we going to do this? So for each earnings call for a given firm that might be based in one of my 71 countries that's held at a given point in time, I'm going to go through the text. I'm going to go look at all the phrases in the text, and I'm going to just count the number of times I see the word Brexit. And what's kind of nice about Brexit as an example is that it's very hard to talk about Brexit without saying the word Brexit. And the word Brexit doesn't really mean anything else than Brexit. So in some sense, the UK did us a favor here of designing almost a perfect natural experiment. More generally, when you try to apply these methods to other topics that don't have like one very specific like word creation associated with it, you're going to have to think a little bit more about how to select keywords. And I might have time to talk about that a little bit at the end. So when they talk about Brexit, we want to know, are they worried about risks associated with Brexit, or are they kind of thinking Brexit is either good or bad news for them? So specifically, when I want to measure risks associated with Brexit for a given firm at a given point in time, I'm going to go through the conversation. I'm going to go look again for mentions of the word Brexit. And then I look 10 words before and after the mention of the word Brexit and see if I can find a synonym for risk or uncertainty. So the way to think about this is if they say both Brexit and risk in the same sentence, then that means that there's something about Brexit that's generating risk for the firm. And I'll show you some examples of that later. So essentially, for each earnings call transcript for each firm in each quarter, I'm just going to count how often do they say both Brexit and risk at the same time. And then I'm going to divide by the length of the transcript, and that's going to be my measure of Brexit risk. When we measure risks associated with a given topic, we also want to distinguish that from good or bad news. So in general, you might expect that when there's risk generated by a given event, that same event tends to also be bad news. So one way of getting a handle on that is, again, going through the text and looking for the word Brexit, and then 10 words before and after, I'm going to look, do I find happy or sad tone words? So if they say something like, Brexit is terrible for us, I'm going to count -1. Brexit is a really good deal for us, I'm going to count +1. So I'm going to basically deduct sad mentions of Brexit from happy mentions of Brexit. And again, divide by the length of the transcript to have a measure for, does this firm expect positive or negative impacts from Brexit on their business? Thankfully, Laurence and McDonald, those are researchers that have been working on sentiment analysis, have already kind of compiled a catalog of happy and sad words in the financial context, and that's what we're using here to measure what we call the first moment impact of Brexit, meaning good or bad news. All right, so now I have my formulas done. I'm going to press enter, and I'm going to score my my transcripts for 7,000 plus firms around the world. And then I'm going to get for each firm in each quarter a measure of Brexit risk, Brexit sentiment, and Brexit exposure. Just to show you that kind of there's valuable information in these measures of Brexit exposure, I just want to show you that firms that talk a lot about Brexit tend to be headquartered in the United Kingdom or tend to have a subsidiary in the United Kingdom. You also find that EU firms, as you might expect, are talking more about Brexit on average than non-EU firms. And generally, firms that sell more in the UK also talk more about Brexit. So this is just sort of a sanity check. Here's a time series of Brexit-related risk as perceived by non-UK firms. So these are international firms that are outside of the UK. And I've scaled this graph so that these numbers here compare to the Brexit risk of the average UK firm post-2016. So that means that, so what this means is here at the peak of Brexit risk in the second quarter of 2016, when the Brexit vote happened, the average non-UK firm in our sample was about 40% as worried about Brexit as the average UK firm. So what this means is that international firms are really watching this event a lot, and it's an important determinant of risks that they're facing during this period. You kind of see a lull here, and as we approach the actual execution of hard Brexit, Brexit risk goes up again. Compare this to the UK, as I kind of mentioned already, this is kind of calibrated so that on average, there's a 1 here for the UK firms. They have a peak in 2016, and then it goes off the charts in 2018 when there's a probability of a really kind of acrimonious hard Brexit, and it kind of stays at high levels until the end of our sample. What's quite instructive is looking at the average Brexit risk by country. And so we have a number of firms headquartered in each country, and just averaging across their Brexit risk kind of shows that Irish firms here are significantly, and this is statistically significant, significantly more worried about Brexit than UK firms. And if you've kind of like, if you've read about trade theory, so trade economists would know why that is. So the reason is that Ireland is kind of quite geographically isolated. If they're not doing business with the UK, it's kind of, it's almost like Ireland is moving further into the sea. So Irish firms very worried. Then you can sort of see that other countries that are quite worried are, as you might expect, EU countries, but then also countries that historically have links to the UK, like South Africa, the UK Channel Islands. And if you go further down the list, you're going to see that the US and Greece have about the same level of worry about Brexit. And the reason for this is that many US firms access the European market through the UK. There's a lot of historical links between the two, obviously. Let me just kind of show you like an example from of discussions of Brexit risk. So greater uncertainty, this uncertainty has been exasperated by Brexit, and the prospect of Brexit has resulted in a high degree. Okay, so been affected by the post-Brexit uncertainty, which has seen weaker sterling. And so these are kind of examples of conversations that we're picking up here. So where executives say that they're worried about Brexit. Another interesting question is, can we find groups of or countries where the average firm is kind of happy about Brexit? So taking at face value our measure of Brexit sentiment, you just go and look at the average across country again, see that the Irish are particularly worried about Brexit, or particularly sad about Brexit. Now, if you go across here, what you see is that basically firms in all countries on average have negative things to say about Brexit. The only exception of this, the only exception we could find here are firms that are based in this historically is involved in tax dodges. Yeah, so that's the only, aside from the Philippines here, we also have a small positive number here. I'm not quite sure where that came from. But this is kind of really quite telling about the economic damage that executives expect to result from Brexit. We then wanted to know what are executives saying about the impacts of Brexit on their firm. And in particular, what we can do is we can take all the conversations where executives say positive things about Brexit and try to sort them into piles. So there's not a whole lot of them. We have about 500 excerpts of firms that say positive things about Brexit, and we categorize them. What we found is that most of the executives that have positive things to say about Brexit said, oh, thankfully we're not exposed to Brexit. Another 16% had positive things to say about Brexit because it weakened the pound, and that was good for their sales. Very few, particularly UK firms, said that they're going to have better trade access to kind of specific foreign countries or trade protection within the UK. So imagine you're a UK firm and you're facing competition from EU countries. You might actually be happy about Brexit because that means your competitors are going to have a harder time accessing your home market. Notably, we found, and these are kind of two topics that were really kind of pushed by the Vote Leave campaign, we found no UK firms that said anything about positive impacts of higher government expenditures. Remember, like NHS gets this much more per week, or even less regulation. So this was kind of surprising to us. So just to give you an example here, saying things about with the weak pound, we saw a spike in leisure occupancy after Brexit, after the Brexit referendum in June, as tourists took advantage of their cheaper pound. Yes, so it makes total sense that within the UK, there's going to be some firms that benefit from that large depreciation. Then looking at negative Brexit sentiment, we're going to do the same thing. When executives say negative things about Brexit, what are they saying? Now, as someone who works on international finance, I know that whenever there's a depreciation, there's going to be winners and losers. So you can see that, a large number of non-UK firms were then complaining about the depreciation of the pound and the effect of that on their business. There's a lot of worry about worse trade access, labor market frictions, falling consumer confidence, and adjustment and transition costs. Just to give you some idea, so the labor market is getting tighter. Brexit will bring additional challenges with regard to particularly experienced people within all over banking organizations. So this is a firm that's worried about labor force being able to move to the UK. So to show you that this measure now can pick up economically meaningful, or can help us understand economically meaningful variation in asset prices, we're going to do what's called an event study. So in an event study, you run a regression of the return, so how much a given stock appreciated around the announcement of the Brexit referendum, on Brexit risk and Brexit sentiment. And if our measures are doing what they should, then we would expect that firms that are more affected by Brexit risk to lose market value when it becomes clear that there is going to be a Brexit on the date of the Brexit referendum. And firms that have positive exposure or positive Brexit sentiment should gain value. And this is exactly what you see. So if I run a regression of stock returns on firm stock returns between June 24th and 28th, 2016, this is straddling the announcement of the referendum results. On Brexit risk and Brexit sentiment, what you see is that firms that have a Brexit risk similar to the average UK firm are going to lose 1.1% of their market value. And similarly, I see a positive loading here on Brexit sentiment, which is what I was expecting. Yeah, so if you say positive things about Brexit, then around the Brexit referendum, you gain value. If you say negative things about Brexit, then around the announcement of the Brexit referendum, then you lost relative market value compared to all other firms in our sample. Now, interestingly, the same thing works if you look only at US firms, and I'll have more to say about that later. So finally, I want to talk about the firm level effects of Brexit. So a big outstanding question is whether uncertainty generated by an event like Brexit can affect firms in third countries. So Emmanuel Macron made a big deal out of this in various public announcements, where sometimes he was arguing that we just need to get Brexit done because the uncertainty relating to Brexit is so bad for French firms. Now, can we find support of for this idea in the data? So one way of answering that question is to take some firm level outcome that reflects firm decisions, like, for example, the firm's investment rate, and relate it to the amount of Brexit risk and the amounts of Brexit sentiment that the firm is perceiving. I'm going to have fixed effects for countries, time, and sectors here. So let me show you what we get. So here's just a graphical representation. So what you see here is that, so I'm plotting the firm's investment rate over Brexit risk both separately for UK firms and non-UK firms. And what you see here is that there's a clear negative association between the two, both in the UK and abroad. So international firms that talk more about risks associated with Brexit invest less than international firms that are not concerned about Brexit. Those are the ones over here. So if you do this in a regression, on the left-hand side, the firm's investment rate, on the right-hand side, Brexit risk and Brexit sentiment. What you see here is there's no effect of Brexit sentiment before Brexit is actually executed, right? So remember, our sample ends in 2019 intentionally because what we wanted to do is we wanted to see what is the effect of Brexit uncertainty before it actually happens. And what you see pretty clearly here is the effects of Brexit before it happens are stemming from uncertainty. So this is exactly what Emmanuel Macron was saying. Firms that worry about Brexit, in the sense that they don't know exactly what's going to happen, is it going to be hard Brexit or soft Brexit, or maybe it's going to be blown off or never going to happen, what they do is they retrench their investment. And what's important is that you can show this, you can empirically distinguish between the effects of Brexit risk and non-Brexit risks. So in the same way that I measure Brexit risk by going and looking in the text when they say Brexit, do they say anything about risk? I can also go and count the number of times they say risk in conversations that have nothing to do with Brexit. So what you see is that there's a general effect of risk, which is just when firms talk more about risks, they invest less. This is kind of like very much in line with kind of canonical economic theory. And compare these two coefficients. So it kind of looks like, risks that are generated by Brexit and risks that are generated by other things actually are kind of similar. We have similar coefficients here on the two. And generally, when firms say positive things, they invest more. When they say negative things, they invest less on non-Brexit related subjects. So what do we see here? So it's kind of useful to maybe try and, before I get there. And what's kind of interesting is I can show this effect of Brexit uncertainty even when I focus only on US-based firms. So I'm looking only at firms that have their headquarters in the United States. And I can see that firms that talk more about Brexit risks during this period invest significantly less than firms that do not. So to translate this into kind of like some economic magnitudes that might be easier to interpret, is that given their Brexit exposures, the investment rates of Irish firms fell by 0.75 percentage point, and the average UK firms by about 0.43 percentage points. Yeah, so this is a sizable effect. It's not the most important thing that's going on at the time, but it's definitely a drag on investment. And how much of a drag it is depends how exposed your firms are to risks associated with, specifically risks associated with Brexit. So for the US, this would account for a 0.1 percentage point decrease in the overall investment rate of US firms, which is quite sizable given that you would think that most firms in the US actually, most firms in our sample, most US firms in our sample do not interact with the UK in any way, shape, or form. Okay, let me maybe skip this here. Another important question is whether firms adjust their employment decisions. So what economic theory would tell you is that firms, when faced with more risk, are going to basically lay off any decisions, or going to try and put off any decisions that have adjustment costs associated with them. So one of that is investment. When you invest more, that's kind of costly to like install new machines and order new machines and so forth. But the same is true for employment. If you employ people, it's kind of first of all hard to like find people to hire, but then it's also often hard to let them go again. So what you see is that there's also a direct effect here that we can measure of Brexit risk on firm level employment growth, where firms that are more affected by Brexit risk have lower employment growth. So again, for the average Irish firms, this year would reduce employment growth by 0.5 percentage point. Okay, so let me kind of just briefly mention, in the paper we then discuss, so we've now characterized the effects of Brexit risk on non-UK firms. Now you can use the same method to figure out the effects of other shocks that happen in third countries on international firms. And one example that we have in the paper for this is the Fukushima incident of 2011, where you then basically you go through the same analysis with one difference, which is when you want to know about the Fukushima nuclear disaster, there's no beautiful word creation like Brexit that will pick up all the conversations on the subject. So what you need to do instead is you need to have a method for figuring out good keywords that will reflect discussions of the Fukushima nuclear incident. And what we argue for there is kind of a hybrid between sort of automated and human methods, where you use some kind of like established methods from natural language processing to come up with a list of potential keywords, but then have people sample and read these keywords as they are mentioned in earnings calls to vet them. This is a method that basically tries to minimize both false positives and false negatives. Let me not go into, actually, so I can briefly tell you about this. So here's kind of like the worldwide impact of the Fukushima nuclear disaster. And what's kind of interesting is you see like some impacts really far afield, like in France and in Sweden and in Australia. And these conversations are kind of interesting because they again kind of point towards fairly complex patterns of transmission of these shocks across borders. So there's a lot of existing work that kind of looks at, if there's an earthquake in Japan, who are the customers of firms that are affected by this earthquake abroad, and kind of then look at like what happens to the customers if their suppliers are now kind of knocked out by this earthquake. What we find is that these dependencies across borders are actually much more subtle in many ways. So for example, here in France, you can look at French nuclear firms that have no business relationships with Japan whatsoever. So they're not customers of firms that are affected by the nuclear disaster directly, but instead the reason they worry about the Fukushima disaster going terribly bad is that they worry about the future of nuclear power in France. So I think that's kind of a nice example of international dependencies being really highly complex, right? So why are like so many, we first thought this was kind of a weird tax haven thing, the Cayman Islands and Bermuda. It turns out that a lot of the reinsurance risk a lot of the reinsurance risk for losses that happened in Fukushima landed in the Cayman Islands, and firms that are headquartered in the Cayman Islands, Bermuda. So that's a financial dependency that again you would not get from kind of reading just kind of the input-output matrix or the customer-supplier relationships. Okay, so I think this is an exciting topic. There's lots more to do. Let me conclude. So we introduced a general text-based method for isolating firm-level exposures to costs, benefits, and risks related to specific events. We applied this to Brexit, find widespread concern about Brexit-related risks among non-UK firms. Both UK and non-UK firms overwhelmingly expect negative impacts from regulatory divergence, reduced labor mobility, and reduced trade access. There's no evidence in these earnings calls of economic benefit of the specific economic benefits touted by the Leave campaign, even among UK firms. And Brexit risk significantly reduces investment and employment growth among exposed international firms. And in particular, you can see this effect even if you look only at US firms. Okay, let me conclude there. Thank you so much.
Great, thanks, Tarek. That was a super clear and interesting presentation. I've got a bunch of questions, but I want to start with two. If we take your results, or just taking the results and what they say, then the failure of the Remain campaign to win seems even more surprising, since at least on the firm side, there were no winners. And that makes me wonder whether there is any evidence in your text that some firms perceived transfers from themselves to their workers as a consequence of Brexit. So I'm just groping is there any economic justification or any economic rationale for why many of the people in the UK might have voted for Brexit in the referendum, and they put pressure on their political leaders afterwards. Is there anything along those lines? in
Yeah,
your
so let me clarify one thing. So there are firms that say positive things about Brexit, but not because of but not the things that the Leave campaign was advocating for. The Leave campaign did not say, we want to provide import protection to create little UK monopolists in a variety of industries, right? So that's kind of like, they did not say, we want to generate more export business because by depreciating the pound. Those are the two things that they've achieved, right? They've achieved sort of like giving protections to firms that basically reducing competition among a set of firms, and some of those are happy about it, and they achieved a depreciation. And there's upsides and downsides of both of those.
Right.
In terms of so we have a kind of interesting table in the paper that I think we're going to cut, and I didn't have time to talk about here, where we looked at only the UK and looked at firms headquartered in different parts of the UK and calculated their Brexit risk and Brexit sentiment. And what you do see is that regions of the UK where firms were talking more about Brexit risk and had more negative expectations about Brexit actually vote less for Leave. So it looks like the local voters actually were aware of this problem. But then there's other variables that kind of have less direct links to economics, like the share of UK-born population and average income, that explain most of the variation, as you might have expected. So, yeah.
Okay.
Yeah.
So that's still an outstanding puzzle then. Why didn't the Remain campaign carry the day?
Yeah, I do think that's a big it's a big issue. Yeah.
So another very different question. You didn't talk much about the magnitudes of your investment and employment effects, and you stated what they were, but they look small. They look small relative to what country level analyses suggest was the negative impact of Brexit on UK economic performance. So I'm sure you've seen these studies that try to construct a synthetic set of comparisons to the UK. You look at the growth trajectory before and after. They suggest pretty sizable effects. Multiple percentage points of a shortfall in GDP per capita, real GDP per capita relative to what would have happened absent Brexit. Your numbers don't, if I read them right, don't generate anything like that magnitude of an effect. And I just wonder if you can, first, is that a correct reading of your results? And second, if it is, what do you make of that?
So okay, so one big point that we're making here is that all of this stuff that we're looking at is detectable even before Brexit actually happens, right? So this is purely the effect of uncertainty. And you're right that these effects of uncertainty, we're very proud that we have the statistical power to detect them, but they're not huge. I fully agree with that. But I think maybe the more worrying thing is that if you look at Brexit sentiment in the UK, among UK firms, it's off the scale negative, right? It's like really negative. And what I've shown you is that up to the end of our sample in 2019, which again, now we could go back and look at other kind of like economic outcomes and see now ex post, what can we attribute to Brexit? That's an interesting thing that we should definitely do. So basically the point here is that all of this is showing up even before it hits. So the last thing I would say is that, so I don't think that finding small effects of uncertainty of Brexit means that the execution of Brexit is going to have similarly small effects. The other thing is that in the pre-period, because of the large depreciation of the pound, and there's actually papers about this, that basically the negative effect of Brexit on the UK was kind of delayed because of that depreciation. And I guess now the problem is that as soon as Brexit was executed, we had the COVID pandemic, and there's going to be a bit of a statistical challenge to try and disentangle the partial effects of each of these. But I don't think that the paper says that the effects of actually leaving the EU are going to be small by any stretch of the imagination.
No, for sure. But I think even the pre-execution shortfall in the UK was quite noticeable. say on investment, for example. There are studies that look at that, and larger than what you find.
And this is in an environment where they had artificially inflated demand because of this very kind of appreciated pound.
Right, right. So let me see if Justin has any questions or comments before we go to the floor.
Yeah, I have just a couple of questions. And so this is, I think, a super interesting method and a way to sort of get at the sentiment. I'm interested in the extent to which you're able to isolate just Brexit opinion and what the Brexit reaction, as opposed to a firm having a sort of stance on trade, and it's correlated with lots of other things happening. That's, you know, also going along with Brexit, like you know, uncertainty around like the U.S. election, for example. And so I understand that you have, like, you know, a narrow window around that's like helpful there. I'm curious if you would agree that like a placebo test that said, look at all non-Brexit text in the earnings call, and then looked for a null result on that, if that would be an appropriate placebo in order to establish that you're isolating just Brexit.
Okay, so there's two things. So you're talking about the event study. And
yeah, or in general, that you know, that one concern someone might have, even though you have this relatively narrow window, is that there's, you know, sort of general like exposure to Brexit's correlated with exposure to lots of uncertainty with trading. There's lots of things happening coincident with Brexit, and therefore Brexit might be standing in for, you know, sort of general exposure to uncertainty in the international trading system writ large.
So let me, I guess, like, so the fact that we could do this really surprised us. But let me, like, so I'm not so interested in the event study in a sense, because it's just sort of like a validation. What's a much taller order is to distinguish the effects of Brexit risk from other kinds of risks that the firm is facing, as you say. And, you know, these other kinds of risks might be correlated with Brexit risks. One place in our results where you can see that we have the power to do that is here when I'm throwing in non-Brexit risk. So literally what this is we're statistically isolating the effects of saying risk and Brexit in the same sentence from the effects of saying risk in all other sentences. And you can see that these are highly statistically significant effects, and they're even comparable in magnitude. So if you had in mind a model where all risks that the firms are facing basically have the same effects in the sense that they depress investment, then what I'm showing you here is that we have the power to distinguish the risks that come from a specific place, Brexit. And, you know, if I wanted to get rid of those risks, I would in theory know what to do, just stop Brexit, yeah, and like commit to not doing it. From everything else, like risk about like our competitors are going to do something, risk from like the trade is going to collapse and so forth. Now, expanding on that theme, this is a table I didn't show you, is you can also throw into the same into the regression by the same token a measure of trade policy risk. Yeah, so this is basically sentences where they say something about the trade environment or trade policy and risk at the same time. And again, I can disentangle these two effects. And what I really love is that, you know, the coefficients are the same, which kind of means, you know, like on average, if you say risk 3 times, you know, it might be because, you know, of your competitors, or it might be because of Brexit. It kind of on average has a similar effect. So what we can move towards here, I guess, like what I have in mind is sort of like, as we develop these methods, we can even decompose, like, so basically, if you have, up until now, we were very, or, you know, if you think before, you know, also some of Steve's work kind of tried to like break this open. Before we started using text, in some sense, the closest thing that we had was look at like some assets market-based volatility, right? So you look at implied volatility or realized volatility or something, and that's one number for each firm. What I'm saying is you can now break this apart into what part of risk is coming from which policy, shock, whatever you want, and decompose. And this is kind of a two-way decomposition. You know, maybe in the future, we're going to be able to do decompositions in multiple dimensions.
Yeah, I think that's helpful. Okay, so I have a slightly different question, and it's very much related to the actual sort of labeling of the Brexit risk. And so, the Lauren and McDonald paper that you cite is, super famous for pointing out that the dictionary folks were using before to code things was invalid. And so they came up with this great dictionary. I'm just curious if you hand coded the paragraphs that you label as like negative or positive or risky or not risky. What's the sort of accuracy of the dictionary method?
Yeah, so, and this is across papers. We've written a bunch of papers about this now. My sense is that we're really good at the risk part. So the risk is pretty good. The sentiment often is pretty noisy. And the reason for this is, particularly in Brexit here, so I think what executives have learned is that they want to load up on the positive words that they use. So what they say is things like, and in fact, what we found is that the word despite is the single most frequent positive word in discussions of Brexit. The word despite allows you to say that something is actually bad and then sets you up to saying positive things afterwards. So, so they will say, despite Brexit, we have robust sales growth. So they're kind of gaming the system. So in other words, that has a number of things that you want, like, so one way that we deal with this is that when we try to control for the first moment, we also put in other controls for like how well the firm is doing. It's still the Brexit sentiment the sentiment control is pretty effective, but it's nowhere near as precise when you actually read the snippets as like the risk measure.
Can I just follow up on that? That's a really interesting observation, but it suggests a way to potentially address that, which is if you can identify a handful of these most frequently used, I don't know what the right term is, despite, but type things, and distinguish between executives who speak that way and those who don't, then the ones who don't speak that way, there'd be presumably less, you're getting more accurate sentiment measures.
Yeah,
and should have bigger effects in your regression. So there's an interaction effect to be introduced into your specifications, which captures the style of speaking. That would be interesting just because it might make your results stronger on the economic front, but also kind of getting to what you and Justin are talking about, some implications of the strategic use of language, which at least in economics, I think have not received much attention.
Yeah, so I actually think that like we kind of hand sorted through a bunch of these, and we're debating whether we should change the Laurent. We haven't touched the Laurent McDonald because it's we kind of don't want to touch it, but we've kind of debated whether if you say despite, we're just going to count the entire.
No, but my suggestion isn't to modify their dictionary. My suggestion is to create a typology of CEOs and classify them as speaking plainly like Harry Truman, or speaking strategically like they're advised by their corporate in-house counsel, and see whether you can get any mileage from that.
Yeah, I would. That's a great idea. I wouldn't be surprised if there were trainings for this, and this is just the one that we found.
I'm sure there are. Yeah.
That actually, this is now just an aside, but what is there a spike in Laurent and McDonald words after Laurent and McDonald is published? Because I know that there's also, trading firms are using similar sets of words. I mean, it sort of speaks to the sort of challenge in doing this because the CEOs know the game as well, very much to Steve's point.
Can I jump in, Tarek, here on this point?
Please, yeah.
Yeah, so Tarek presented this event study, right? And so this is looking at the capital markets, how investors respond to the event. So similarly, like academics and finance have conducted like an event study, but then seeing whether in conference call, for example, there's less frequent use of the Laurent and McDonald dictionary words after that paper became public and was published. And in fact, there's some evidence to show that that's indeed the case, that managers are changing their language, knowing that the language gets flagged, for example, by algorithms like hedge funds and that, basing their trading investment decisions using these algorithms. And so there's some evidence indeed that managers are strategically changing their language following the publication of the Laurent and McDonald paper. So that's really cool.
It is. Say, let's go to the Q&A. We have a couple questions. I'm gonna restate in the interest of time. So one from Roy Vella. He asked whether Ireland's concerns might be more geographic rather than economic. And I think he goes on to say, given the border dynamics and the legacy of conflict in that regard. So what I take from that is maybe it's not the traditional factors captured by trade models, but it's rather the notion that in the wake of Brexit, there might be a renewal of political conflict, maybe even civil strife, military conflict around Ireland or North Ireland. And so I think what that leads to is there anything you can say about the character of the especially strong concerns on both the sentiment side and the risk side expressed by Irish firms? Does it look like a standard trade story, or does it look like something else? Political conflict, for example.
So in response to some referee comments, Steve, we actually read them all using some of the methods that you developed. I don't know, Stephan, did you come across anything about civil unrest? I haven't seen any of it.
I have to be honest, I've read too many of them, but this is a really cool question. I think I have to go back and read some more.
It does seem like it warrants a paragraph, given how much Ireland stands out in your paper about, well, what exactly are these Irish firms concerned about? Is it a standard economic trade story, or is it something else? Okay, so let me go on to the next. Then Scott DeYoung has a question, which is somewhat related to the one I asked earlier, but I'll give you another crack at it. He says, given that you found little or no economic benefit from Brexit among the firms that you were looking at, what was attracting the voters, I guess, in the UK? What non-economic policy from the EU stimulated Brexit? It's a little bit outside the scope of your analysis, but if you have thoughts on that, be good to share them.
Yeah, so this is the closest we got. So this regional analysis for each voting district. We assigned them the average Brexit risk of the firms that are headquartered there and the average Brexit sentiment. And you see here that Brexit risk and sentiment are doing some of the work. I think the partial R squared is about 10%. So take that as the economic concerns. And then you have these kind of, so share UK born. So these are places that have more UK born residents are much more for leave, and places that are poor are much more for leave. So you can sort of see, I mean, and there's actually papers about this, right? And in general, I think there's probably no question. I would be hard pressed to come up with any question of economic policy where I don't think there was any kind of real disagreement among economists about how terrible an idea Brexit is. So in some sense, I think we'd be hard pressed to really find an economic rationale for the whole thing. But what you do see is that basically what the firms are saying is totally reflected here, is partially reflected in the local voting results. But it's maybe battling these more native. So if you take this as a proxy for how much people are uncomfortable with migrants from the EU, then that kind of seems to trump everything here.
Maybe what's also interesting to mention here is that at the time of the referendum, or shortly before, some company managers were actually calling upon their workers through the transcripts, through the conference calls, to vote against, and then also to give some reasons for why. So there's some clear evidence, anecdotal in this sense, of economic motivations driving people to vote against the Brexit.
Okay, so we got a request from Laurence Klestenek to make your slides available after the seminar. If you're willing to do that, we'll post them on the site. If you want to share your slides, we'll post them on the website for this seminar, Laurence, and anyone else who's interested. Let me ask another question. You stressed in your paper and in your talk that it's the risk effects, not the sentiment effects, that are showing up, at least through 2019. And you suggested that's in line with economic theory. Maybe, but even in a world with no uncertainty and adjustment costs on investment, we'd expect to see anticipation effects kicking in before the actual implementation of Brexit. So and you need some form of adjustment cost even to get uncertainty mattering in advance of the actual outcome. So I do find it a little puzzling, and it may be the measurement challenges you described earlier that are, attenuating the estimated effects on the sentiment measures. But it is a bit of a puzzle, I think, from the perspective of economic theory, that you find much stronger second moment effects than first moment effects. Or do you agree with that assessment?
So that's not generally true for this method, right? So what you see here is that, so that's specifically true for Brexit, but you can sort of see here clearly the association of non-Brexit sentiment with investment. So when they say positive stuff in general, they do invest more. Just specifically, and we've written other papers that have kind of isolated the effects of other shocks, and usually Brexit risk and Brexit sentiment both do work. And in fact, like in our paper about COVID, I think it's a bit reversed, right? So there's much more effects from the actual shock than from uncertainty about COVID. So I would say across papers, and this is not something that like just the evidence in this paper, like the closest piece of evidence in this paper is really just kind of this coefficient here.
Okay.
But I do think, so I think what is safe to say that compared to other episodes that we have looked at, for Brexit stands out in that before it was actually implemented, there is a much larger effect of the second moment than the first moment. I think that's fair to say. Now, I agree with you that there's measurement challenges that are maybe specific to Brexit and so forth, and maybe overall we're not as good at sentiment as at risk.
Well, but the fact that your non-Brexit sentiment shows up so powerfully, it seems to me, cuts against the measurement error story, because the same measurement error issues arise there. So then that makes me think we ought to be looking for an economic explanation of why the Brexit risk shows up so much more powerfully than the Brexit sentiment, and why it's different for Brexit than for these other episodes and for non-Brexit risk and sentiment. Do you have any thoughts on that? It
is in some sense, I mean, so Nick Bloom was arguing that it's like a textbook sort of, that it's, so it is a very rare occurrence that we have like a policy that we don't know whether it's going to happen or not, and we're getting closer and closer in time to it. Like usually there's like, small things start happening, and like usually first and second moments are much more intertwined than in this episode. Yeah, and I mean, keep in mind that like most of our sample here are non-UK firms also, right? So that's important to keep in mind. I think if you look at just the US firms, it's kind of plausible that like, we expect to take a hit from Brexit, but it hasn't happened yet. So we're not really going to change anything. It's kind of 5% of our sales or whatever. It's not like existential. I think in the UK, if there weren't so many things going on at the same time in the UK, in particular, the depreciation that happened, right? So that was like in the UK, you might expect so I guess like in the UK, I would expect much larger first moment effects right away, because it's just much more of everyone's portfolio that's affected.
Right. So we've got a question here. We've got a question here from Peter Liu that I'm going to paraphrase, because I think it's a broad point about your data. It says, could it be the case that companies that participated in conference calls are only part of business communities comprised of mainly large businesses that may not represent the business community as a whole? Certain sectors tend to be dominated by smaller business. I think that's even more true outside the US and the UK. So can you comment on that aspect? There's a non-representativeness to the companies that show up in your study.
So we have another paper on measuring country risk using these methods, and we kind of did a pretty careful sort of analysis on what firms are in the sample for which country. And it is true that, so US firms are vastly overrepresented. So you can basically think like all listed US firms are in this sample. And then for international countries, it's like, so if you just look at like the biggest 45 economies in the world, by 2019, we cover half of market cap for almost all of them.
Yeah, but
but those are, and that's driven by the very largest firms. So basically, so that's driven by the very largest firms in those countries, and it's sometimes only a handful that we have. And and basically there's there's selection into having conference calls in the first place, But then there's also selection among international firms about, are you holding them in English or are you translating them into English? And so as you might have expected, in basically almost all cases, it's the largest firms in the country that comply with both of these two things.
Yeah, but there's an even more fundamental selection, which you didn't talk about, which is being listed. So
Right.
even in the US, listed firms are only about a quarter of private sector employment. And in most of the world, listed firms are just a tiny share of employment and small shares of economic activity. So is it possible that listed firms just had a much more negative reaction to Brexit?
Yeah, so I guess if you asked Boris Johnson, he would have said, "I'm doing this to protect the local gardening companies." I don't have any evidence that they're unhappy about either way. Yeah. So
well, you could
yeah.
provide, at least for the UK and the US, where you have large numbers of firms, you could tell us whether small domestically oriented firms look significantly different in their assessment of Brexit than other firms, to try to get closer to the local gardener or the local, I don't know, pub or something, whatever Boris Johnson was appealing to. It does seem like that's worth exploring.
That's a great idea. We haven't done that. I don't think, Stephan, I don't think we ever looked at variation in sentiment across size.
No.
It's kind of the intersection of size and domesticness, right? Kind of want to look at, because some small firms may be highly integrated into the global economy. They're presumably not the ones you're trying to isolate for this purpose.
Let me just see, we have something like, but this is again for international firms, right? So this paper is very much focused on international firms, and what you see here, so this was kind of interesting, right? So if you we were trying to knock out, so you can actually look at like our best guess of like their share of UK sales. And again, like all the Brexit risk is doing all the work. I'm wondering if this might have changed ex post, but that's another variable to select on, right? So we could say, is sentiment more negative? We should run a regression with like Brexit sentiment on the left-hand side and just firm characteristics on the right-hand side and see what we find. We haven't done that. I don't think we've done that.
All right, Justin, any more questions or comments from you? Okay, great. We're gonna, I want to thank the authors. This was really great stuff. I enjoyed it a lot and learned a lot. We're gonna end the recorded session now and move to an informal session. Let me also say that we're gonna take a break for the summer. So if this has become a steady part of your intellectual diet, we'll resume in September with these seminars. And thanks to those of you who have been regularly viewing or participating, thanks a lot. And we're really thrilled to have you, and we hope to see you again in September. Thank you, Tarek. Thank you, Stephan. And we'll see you on in just a second again.